Have you ever considered what kind of investor you really are? Are you an active investor? Are you a passive investor? In today's video, we're going to be breaking down just that. And of course, put your comments down below. What kind of investor are you? So when we think to active investing, a lot of people think this is the way to make money versus the passive investing. After all, we're very prone to see the activity as more powerful, more dynamic, more capable of investing and making the strategies work. Active and passive investing have both positive and negatives. We're going to be breaking down in this video. And of course, when you think of investors in general overall, a majority of passive investors through index fund investing or ETFs are the most really profitable investors that we do see. So why do we think of that as we look at today's stock market and all the changes that we've seen, of course, with the presidential election? It has been absolutely crazy on fire when it comes to everything, looking at bonds going up, looking at the stock market going up, your ETFs, your cryptocurrency, everything across the board has been investing and really going up today. So what exactly is active investing? Now, this is what you see, the films, the TV shows, all the glitz, all the glamour. This is when you try to time the market, when you're doing buys and sells, looking for something that is undervalued, gonna purchase it, ride it till it builds up a little bit, sell it when it gets high enough to take a margin. And this is what a lot of people are not only doing with stocks, but we are also seeing a huge rise of this with cryptocurrency, being able to trade that, essentially buying something, let's say at $50, you ride it out the entire day, you sell out at the end of the day for that $70, making the $20 profit. But of course, it involves a lot of analytics. It involves a lot of insight, knowledge of the market, how to do this. And of course, if you're a short-term trader, depending on how many trades you do, that could make a big difference on if you can and what you can buy and sell and what platform you're using. So thinking of the advantages of this, number one, biggest one for active traders and active investing is the higher returns. If you're skilled, the sky is the limit for this. If you're researching and you're investing, a lot of people even choose one single stock or one single cryptocurrency that they trade on a regular basis, looking at where the trends are and how they're going. But of course, this is also the big part, and the big disadvantage of this is you can lose a ton of money. If you buy something in that same scenario where you buy it at $50, by the end of the day, it's worth $20. Are you going to hold on to it hoping it's going to go up? Are you going to take the passive approach, or are you going to sell it at a loss of that $30? That entirely is up to you. Now, of course, another advantage is fun. To follow the market, to test your skills, it can be incredibly fun, but it can be incredibly time consuming. I used to trade cryptocurrency, and that's exactly what it was. Trying to time the market, making money kind of little by little when you only have a little to put into the market made a big difference, but emotionally, it was an absolute roller coaster staring at the charts every 15 minutes, 30 minutes, every hour, seeing exactly where they're going and where you think they're going to be trending. So what are some of the disadvantages to the active trading? Hard to beat professional traders. Even when you think of the S&P 500, and we always go back to Warren Buffett, he said 90% of the traders over an extended amount of time cannot beat the market itself, like the S&P 500, meaning it is very hard. Now, if you're a good day trader, again, the sky is the limit with the amount of money that you can make. High powered, high speed, really data, the more you can take in and the faster you can do it. And a lot of people are doing this now with artificial intelligence and a couple other tools, including bots. Now, another disadvantage, most active traders, like we said, do not beat the market. Reporting the S&P Dow Jones, 60% of US managed funds and large companies underperform the benchmark. So again, kind of crazy according to 2023 data. It can require a lot of skill, and it can run up a very large tax bill if you're not familiar with it. If you have a lot of gains, chances are you're going to have a lot of net gains. You might have a lot of capital gains, and you could have a huge tax bill out really at the end of the year. It could take a lot of time, and investors often buy and sell at worrisome times. This is the opposite that really people need to be investing in. People do need to be buying. When you think of human psychology, it is focused on minimizing the pain, meaning, again, when we use that scenario, buying that $50 stock, you start seeing it go down. Guess what? You want to sell. It gets to, $30. You want to sell. $25. You need to sell. 20. You have to sell. Boom, you're out. You're completely done. You're never going to do it again. But the best part and the best time to buy it is when it's going down. That is the way to make the most of your money, is when you start seeing the stock market, let's say it's at 100%, it goes down, it drops 10%, now you're at 90%, perfect time to buy. You're gonna get a 10% discount on everything that you're purchasing, which for a majority of people, very counterintuitive to look at it at a discount, and that is not how most people do view the stock market when it comes to investing. Now, my favorite form and the one that I use, what is passive investing? When we think of passive investing, it is the long-term hold. When you think of ETFs, when you think of stocks, when you think of cryptocurrency, Bitcoin, Ethereum, the buy and hold strategy is the long-term approach. This is when, especially when you're buying index funds, we are looking at 5+ years. It is not going to be us kind of churning over different ETFs, getting capital gains, doing buys, doing sells. And you want to go ahead and buy, and this is what I recommend, into ETFs like the VOO, the S&P 500. I do not want to hold individual stocks, and I do not hold any individual stocks at all. The reason being, when I buy an ETF, it is instant diversification across all of the sectors of the market, and making sure that we have, a little bit heavier into tech, which is usually leads to not only bigger market cap, but it also leads to a lot of growth. And of course, I'm not too worried about outpacing the index, beating the market. I at least want to get that 10% return that we have seen from the S&P 500. So what are the advantages? Beats most investors over time. That is the big thing. Passive investors are trying to beat the market instead of just taking the market and really being the market makers. They want to do it themselves during the index funds, different stocks, different bonds, depending on their holding. But of course, the S&P 500 average return is about 10% over an extended amount of time. Most people cannot beat that. They might have a year or two where they do, maybe a year or two where they underperform. When you start looking at the averages, most financial advisors cannot beat that. It's easier to succeed at. This is one of the big things. When you think of passive investing, when you're putting money in, dollar cost averaging in, for me, I put $250 in every single week on Monday morning. That's it. Get it and forget it. As long as I have an account that has enough funds in my high yield savings account, it is going to continue investing $1,000 every single month, or $1,250 depending on how the weeks fall. But overall, I don't have to do the legwork. I'm not doing the research. I am just letting it, very low fee index funds, putting it in that VOO, putting it in the VUG, being a passive investor and putting it in there, which of course is the approach when you look at Warren Buffett, keeping the money in there. Now, in addition, you have deferred capital gains tax. This is another one that they are deferred until you sell. So you don't have a really big tax burden, and you know exactly what you're going to. Now, required minimum time, best case scenario, investors are looking 15 to 20 minutes tax time every year. When they're done with the investing, again, it's very easy. I just put money in and let a company's success drive your returns. That is another big thing. When you think of a company's success, when you're buying 500 companies in that S&P 500 fund, it makes a big difference. If you have 300 that are doing well, 200 that are underperforming, essentially the weighted average, depending on which companies those are, you are still going to see and get the average return. Now, this can also be viewed as a disadvantage of passive investing. You get an average return. You're not getting, the 30, 40, 50% return. You're not seeing the returns that we get from cryptocurrency. We are looking for our very slow, boring portfolios, as a lot of you have mentioned. My very slow, boring portfolio, that is doing incredibly well. You know what? I'm up 80% in the last 3 years and 1 month, which is kind of crazy through dollar cost averaging. In 2021, when the market started declining, I bought it every single week like we're doing right now. I was putting a lot of money in there every single week. So all the way down as the market declined, we did invest in there. Then, of course, when you start looking at 22 and 23, markets started rebounding, started coming back. I owned exponentially more of the ETFs that I was investing in, and it makes a big difference. And I will continue that dollar cost averaging until that money is gone, which is getting replenished every 2 weeks. So it's never going to run out until I retire and quit doing contributions in there. Now, of course, the other disadvantage, you still have to know what you own. You have to do your own research. You have to know and understand the risk, what you're putting into the ETFs, what you're putting into your portfolio. And of course, a lot of ETFs, if you're taking that long-term approach, there usually isn't a lot of change. Even thinking of something like a dividend ETF like HD, it is rebalanced or adjusted one single time a year. That's it. Talk about a get it and really forget it. As long as you're putting money in there consistently, you're getting a pretty good yield, about 3.4 to 3.6%. You're getting a pretty decent yield. You're also seeing a lot of value, getting some growth out of that ETF. And overall, you can just put your money in there and kind of forget it. So active versus passive, which strategy is really best for you? This comes down to the individual, and this is where you got to sit down, think about your goals. So when active investing is better, you want to spend more time doing it, you enjoy doing it, you like the rise and the falls, you're doing your research, you can really outguess, millions of smart investors that are out there. You don't mind the losses, because if you cannot stomach that, definitely active investing, and again, I've done this before with crypto, is not for you at all. You're looking for mastery, you're looking how to read charts, you're looking how to really pace the market or kind of forecast which way it's headed. Then when it comes to the passive investing, if this is the investor that you are, you want good returns, willing to give up the chase to really get those best or those high returns. You want to beat most investors, even the pros, most of the time with those S&P 500 funds. You're comfortable investing in those index funds, don't want to spend a lot of time, want to minimize that tax liability. And of course, you want a hands-off approach. Similar to me, when it comes to investing, I do passive investing in its entirety. I don't do any trading. If I trade, it might be a rebalance or it might be something that I add, like the Bitcoin ETF. But short of that, not really anything that I'm doing as far as the investing strategy. Keeping it very similar, keeping it very slow and really steady with the 3 ETF portfolio, making it really a big difference, and it continues to grow. We're almost up to $160,000 in the portfolio, so doing incredibly well. So, all right, guys, so that is going to do it for the video. Passive versus active investing. Which kind of investor are you? Let me know in the comments, and I'll catch you in the next video.